Hello, fellow traders. 'Tis I, the Rumpled One. It is Monday, March the 12th, the year 2018. Let's talk trading. When to get out. I think I want to continue along talking about exits because it seems like it's a popular topic amongst traders. And I think part of the reason it's popular is because we have a bad habit of the what could have happened, meaning you enter a trade, you exit, you got 5 pips, and then it pulls back a little bit, and then it takes off, and you're like, dang it, I could have. Well, you see, once you exit the trade, forget about it. It's all over. It's done. And you have to accept the fact that sometimes you're going to miss out on a big run. I mean, yesterday I was looking at the yen and I was thinking, I think I should buy the yen here. The dollar yen. And so I did. And then it went up about a pip or two. Then it reversed on me. And so I'm thinking, well, I guess I should have waited. So right there, I'm starting to second guess. I'm starting a Monday morning quarterback. Well, then it came back and I was up about 5 or 7 pips. So what I did was I moved my break-even to break-even plus 1, entry plus 1. I moved my stop loss to break-even plus 1. And, of course, I got stopped out. But I was okay. Why? Because now it's about, 20 pips below where I entered. But the thing is, you see, you can't be really focused on the individual result of each and every trade because it will drive you bat crazy. What you want to do is instead you want to say, did I exit according to plan? Did I enter according to plan? Did I do everything according to plan? Because see, if your plan is sound and solid and your method is sound and solid, then the results are going to take care of themselves over the long haul. That's why I say you need to do 100 pips or 100 trades of a method. And in fact, I think next month there's an entry that or system or method that somebody one of the donators introduced me to a couple months ago, and I've been working on the indicators. And what I might do is maybe for the better part of next month is trade that system alone, see if I can get 100 trades in and see if it's profitable or not. Just because. It's an exercise in discipline. It's not that none of my methods work, so I got to find some other method. No. Every now and then it's good to step outside of your normal routine, do something new to see if you have the discipline to execute properly. That being said, no matter what method, you have to have the discipline to execute your money and risk management properly. You have to focus on that. Doesn't matter what the method is. This is something separate. It's not really part of. Your money and risk management has nothing to do with the method you are using. You have to control the risk of the dollars or percent you're willing to lose on each and every trade. So let's take a look here. Okay, dollar Canadian is moving up. It did crack that bottom here, but now it's moving up. We can see it's 16 pips over the weekly open. It's 27 pips off the low. And we only have a couple of Australian pairs that haven't filled, but the rest have. Looking at the daily, we can see here once again what's going on. We're coming back up. You can see right there it tested and it came above that level. Now we're 28 pips off the low. Okay, a couple of the pound pairs have some nice ranges, but you can see don't really have that many big ranges happening. Looking at the buy zone right there, not much of a trigger to the, or you got your trigger to the downside. That looks like a scratch trade. There you go. Maybe you took that entry, maybe you waited, but there you have a payoff, and here you have another payoff. And you can see right here how price bounced right off that daily open, which also happens to be the weekly open. Right there, bounced off of it. So there might have been a clue right there. And as you can see, we don't even, rat zone, we only have what? 38 pip range, not enough for rat zone trade. And we can look at the pivot. As you can see here, if you have your open, you have your pivot. If you just faded toward the pivot, you'd be in profit. Price action, once again, simple price action at the line or a turn trade. And you can see whether or not it pays off. I mean, right here, it would have paid off. Right here, it would have paid off. Right there, it would have paid off. These greens, that might have been a scratch trade. There was probably 4 or 5 pips. Right here, you've got what? 20 pip run. Now, we're talking about when to exit. You see you had a 20 pip run. Why not just take the 20 pips? I mean, sometimes you say, hey, you know what? Let me bag 20 pips because chances of it going further might be slim and none. I mean, if you scrunch the chart up here, you can see this action. You know, it hit this level, the 2840s, and came right through it. Came right through it. Here, you see it didn't go above it. So there's another little clue right there saying, no, I'll take 20 pips on a trade and I can move on. Now, of course, it could have been 30 pips, but it could have been 40 or more. But right there, you had 20 in hand. How often do you get 20 pips? Sometimes you just got to take what you can. And you saw it had a 2-ball. So yeah, that 2-ball could have pushed up to a 3-ball, but it didn't. And see, that's the whole thing. The coulda, it coulda, it coulda. You almost quit saying it coulda. Saying, this is what's happened. I've got 20 pips. Do I want those 20 pips, or am I willing to give some back to see if I can get more? It's just that simple. So that's why before you enter the trade, you need to have your exit playbook. Because in the way I do the exit playbook, you've already decided what you're going to do when price moves to break even, when price moves to break even plus 5, break even plus 10, break even plus, you've already got it planned out. You know exactly what to do. And then you just let the market reward you. So maybe right here, you get up 10 pips, maybe you take half off and you let the rest ride. Maybe you get up 20 pips, you take half off. Maybe you take 80% off of the trade and you leave some in the game. I mean, it's that simple. Maybe you say, okay, I take off half. Now I can leave my stop where it is and give it plenty of room to wiggle, or I can move my stop up to break even +1, make sure that this trade doesn't go negative, even the partial, the 20% that's left on. So you have to make those decisions ahead of time. You just sit down, watch a couple of my exit playbook videos and put your exit playbook together. In fact, you can use the My Notes indicator. This is the one right here, the My Notes. And you can actually put your notes on the screen. Usually I put it on this side of the screen. And you can have your rules right there so you know. Once again, here we go. The 5 lines from yesterday's daily candle, or the previous session's daily candle. I have to say previous session because, see, this is Monday and yesterday was Sunday, but we don't really have Sunday, Saturday candles, so you have to say previous session to be accurate and precise with the language. But once again, you can see here, entering long at those lines or entering short could pay off. That would have probably been a scratch trade right there, or 1 pipper, because you see it tried to make a break through that daily low and didn't, so it just scratched the trade. Because once again, when to exit, if you see price struggling, just really struggling to move in the direction you want to, and you're up a few pips, you just have to look at where's it struggling to, and you can just exit the trade. What, you don't have to fight it. Here we go. Lower wick zone. Right there, lower wick zone. What happened? It exited the wick zone. We see this every day, don't we? And the holo zone. See, it put in a high, came in here, and came back down. Pips to be made. See right there. Now, if you take that short, think about it. The day is up, right? So you might take those 5, 10 pips. See, what was that trade worth? Worth what? 7 pips or so? So yeah, you take a 5 pip. Just take it. Throw it on the stack. And once again, having something like looking at it on a tick basis, you can see, is it buying, is it selling? And people want to know what all these lines are. I thought I explained. Let me see if I could do it quickly. This is the highest high, or the highest bid since I turned the indicator on. This here, this is the lowest ask since I turned the indicator on. Okay, this purple, this is the midpoint. This hash line, this is the open line. Okay, now the blue squiggly, that's the bid. The magenta squiggly or hot pink, I forget what color that technically is. I guess I can look it up real quick. Tick chart, input, color mid magenta, color ask hot pink. Yeah, hot pink. So once again, you can see here, this is the highest bid. So if the ask comes below, now we have selling. Because for price to drop, the ask has to come below it. That's the whole idea. So if you're in a trade and you're long, and you're like, okay, so long as the ask doesn't go below the highest peak here, doesn't go below that, then I can stay long. But if it does come below it, then maybe I should take the money off the table. And sometimes, like right here, it came below, and then all of a sudden, boom, it came back up and ran up here. So, but that's why you really need your exit playbook. Simple candle color. You got H1 red. Everything else looks like it's going up. You choose. So, fellow traders, I hope that helps. If you have questions, feel free to pop those questions. I'll try to answer them. And remember, it's not what you trade, it's how you trade it. The Rumpled One signing off to go drain the banks.